Stock markets look for catalysts. They edge higher a little bit again, but they don't really make any lasting headway through the highs established in the wake of last week's jumbo-sized Fed rate cut and the news that the Fed has basically endorsed all of what the markets were hoping from the central bank and its outlook for the rest of this year and next. But China attempts a stimulus push of its own. And that's what we're going to focus on here. A big announcement coming from the world's second largest economy overnight, and lots of optimism in local markets. And of course, the key question, will this be the key differentiator? Will this finally put global growth on more solid footing than just looking at the US and hoping that the Fed won't miss its window? That is to say, will China finally emerge as a true safety net for the global economy as worries about recession risk continue? This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And that's what we are going to focus on here today. So we are going to unpack what actually came out of China. We are going to consider what it means, what maybe it doesn't mean, and how it fits within the overall sort of dynamics here as we consider where global growth sits and how that might be impacted by these announcements. So let's begin here with, first and foremost, what China did. And here we have a chart from Bloomberg. In the blue there is the average reserve requirement ratio for Chinese banks. That is to say, how much of their deposits are they required to hold on reserve versus lend out. And what we see is that China has been cutting this ratio going back to 2021. This most recent reduction takes it from 7% to 6.6%. We also see that there was a reduction in the 7-day overnight rate. That's essentially China's version of the Fed funds rate or the ECB deposit rate or the RBA bank rate, Bank of England bank rate, the target interest rate for the central bank. And that was cut from 1.7 to 1.5%. But China didn't stop there. There was quite a bit more that got unveiled in addition to these cuts. We also saw that the mortgage payment required on second homes was reduced from 25 to 15%. We see that the average mortgage rate payable on existing, that is outstanding loans, was lowered in the central bank's estimation once all of its efforts are put together by half of a percentage point. All seemingly with a mind to unlock liquidity, to make more capital available. Reducing the reserve requirement ratio means the banks can lend more money. Lowering borrowing costs means that people are encouraged to go borrow because servicing the loans has become incrementally cheaper. Reducing the down payment required for purchasing second homes tells people who are would-be real estate investors, you now need less capital. Go ahead and deploy it. We need to backstop the ailing housing market. All of this seemingly designed to create more liquidity in the economy. On top of all of this, we also have measures to boost the stock market more directly. The PBOC announcing a 500 billion yuan effort to finance Chinese firms buying into the local stock market. That's at local exchange rates about $71 billion, and setting up a swap facility for 800 billion yuan. Again, at local at current exchange rates, that's about $114 billion to help companies finance and to create liquidity for securities companies, funds, insurers to purchase stocks. So a tremendous amount of money dumped on the stock market as well in a more directed and more pointed fashion. And we can see the results. This is ASHR, which is the ETF that tracks China's benchmark CSI 300 index. Those are the top listed names in Shanghai and Shenzhen, and is basically sort of the spiritual equivalent of the S&P 500 for China. And we can see here that clearly there has been an emphatic sort of rally here. To put this in perspective, this is a weekly chart. The gap on the chart was so large that we had to look at this on the weekly chart just to get the scope of really what's going on here in a clear way. So very clearly here, the market is, at the very least at the moment, happy about these developments. Now, this is where things get interesting, and this is where unpacking all of this becomes critical. The global economy is 50% driven by just three big economic engines. The US is about 22%, the Eurozone is about 12%, China is about 16%. I say about because these are the latest estimates from the World Bank, but of course they are dated as GDP data always is. So this is not necessarily a snapshot in time today, but it gives you a sense of how the breakdown works generally. The rest of world 50%, in large part, relies on demand from the former three as vendors. So if you're Canada or Mexico, a good bit of your economic growth is driven by US demand. If you are a country in Central Europe, or one of the Nordic economies, even the G10 Nordic economies, you're very much dependent on Eurozone demand. Switzerland falls into that bucket as well. If you are anywhere in Australia, New Zealand, Southeast Asia, any of the commodity exporting countries clustered in South America, in Africa, you're very much dependent on China, and China in turn very much dependent on demand from the US and the Eurozone. So the actual footprint of these economies is only 50% on the surface, but when you consider that the rest of the 50% depends on demand from the former three, it becomes clear that the world is really balancing precariously on what is a three-legged stool. It's these three economies that really account for where the trajectory of global growth is going. And so it is in this context that this news out of China is so important. As it happens, we just got updates on growth from the US and the Eurozone earlier this week. by way of the latest PMI data from S&P Global. And this is what we find. In the US, the situation is reasonably well supported. We can see here that although the situation in manufacturing continues to look anemic, needless to say, manufacturing seems to be not only shrinking, but doing so at an accelerating speed as ever. The way that PMI data works is 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what you see here is that even though manufacturing is increasingly sinking below 50, you nevertheless have a situation on services that has been holding up the entire economy. So the composite is idling for the past several months, but idling at levels that compare very favorably with recent history. So this right here is May, and this right here is May of last year. So what we see here is that in May, we hit a 12-month high on growth and have basically been idling around there for the next 4 months, including September. And it's not surprising, really. Services has largely echoed that dynamic, even with a slight upward slope. And services is overwhelmingly larger as a contributor to U.S. growth than is manufacturing. So things here perhaps a bit worrying in that manufacturing is earlier typically to find weakness in a business cycle turn, and that may well come back to be an issue in the service sector, but there is no evidence of that here for now. As it stands, the economy for the fourth month in a row is hovering near the strongest growth in 12 months. Situation in Europe is a lot more dire. In fact, we can see that the Eurozone economy unexpectedly shrank in September. This composite index fell back into contraction territory for the first time this year at 48.9 as services fumbled. And so basically standstill here at 50.5 is clearly showing itself to be insufficient to offset increasing deterioration in manufacturing. We can see it's been in contraction mode going all the way back to the middle of 2022. The only thing that we've seen here so far has been gradients of the speed at which things are contracting for European manufacturing. But clearly, this is a picture of weakness. And then if we look at China, it is a similar story of standstill. So we can see here the latest numbers on the service sector just above 50, the latest numbers on the manufacturing side just below 50. And so on net, another case where we have basically nothing moving. And this, of course, raises a very important question. When we compare all of this together, and by the way, those Chinese numbers are as of August. We're going to get the September ones next week. You can see here the expectation for China's composite for next week when those numbers come out is 49. So that would be a contraction. We just saw the Eurozone contracting already and the US holding up. So the way that this has been set up for the current global economic backdrop is the US is essentially the only game in town. And in the Eurozone, you already have a central bank that's cutting rates, and there is hope that perhaps this will have some desired effect, although for the moment, things still look dire. in essence, this means that there is no safety net. If the US gets it wrong, the global economy is out of legs to stand on, which is why this Chinese stimulus is so important. If China can revive its economy, thanks, at least in part, to these efforts, then we could be in a situation where there is a lifeline, and we don't need to be worried so adamantly about the Fed getting their calculus right, because if the US is anything but the immaculate soft landing, then at least there's an offset from growth elsewhere. Well, unfortunately, these efforts in China are unlikely to be that. So let's just quickly remind ourselves how long they've been cutting rates. This is going all the way back to January of 2021 here, and we can see rate cuts for the reserve requirement ratios begin mid-2021, and then going into 2022 is when the benchmark rate starts being cut. So we've been looking at rate cuts here for 2.5, 3 years. Here is what has occurred with the impact, as it were. In the blue are new loans. In the red is a year-on-year rate. And we can see here that this entire run, growth in new loans has slowed, and at one point even fell into negative territory, which is to say there was a drop in lending. So these careful incremented rate cuts have done very little to actually boost loan growth. As a matter of fact, it's been going the wrong way. If we look at the credit impulse for China, this is the share of GDP that is made up of new lending, we can see a dour picture indeed. So we said the beginning of 2022 is where rate cuts begin, and the reserve requirement ratio cuts begin a little bit before that. So take a look at what has happened since. This credit impulse index has idled, and since the beginning of this year, it's looking increasingly low, which is to say that the situation isn't one of a positive credit influence, but of a negative one. In the yellow bars is the year on year, and we can see that for 7 months straight, credit has actually deteriorated as a share of GDP. So this idea that Chinese easing up to now has been successful at stoking the animal spirits, as it were, and pushing people to go borrow, is simply not there. At least thus far, all of these efforts have fallen flat. Now let's consider the measures to boost the stock market and remind ourselves that we've seen this movie before. Just at the beginning of this year, China very loudly fired the head of its securities regulator and basically instructed the sovereign wealth fund to go and buy local stocks. Now, we can see here what this does is it lifts shares for a period from about the middle of January through essentially the mid-year. That juices up volumes for a while. This is the overall aggregate fund flows across northbound and southbound Stock Connect. So money that is being invested by mainland investors into global stocks and by global investors into mainland stocks. This is a linkage that connects Hong Kong and on mainland bourses and essentially allows capital flows to move between them. So what we see is a pickup in stock market enthusiasm that then craters, a run up in shares that then is erased. And indeed, this is not the first time that something like this comes undone. Here's that same move. Here's the sacking of the regulator head. Here's where you get the directive first to buy ETFs and then over here to buy stocks. We can see that there's efforts before then with short selling restrictions and the cutting of stamp duties on stock buying. We've seen that there's been efforts since then with more curbs on short selling, more curbs on quantitative strategies. None of it is doing anything. None of it has been lasting. And there's a very straightforward explanation why, when you give people more credit, they don't take advantage. And when you force stocks higher with essentially government money chasing them upward, ultimately you run into a wall. There's no demand. If we look at what's been going on with private companies' investments since COVID restrictions were released, we can see it's been going down. This is a chart from the Peterson Institute using data from the PBOC and comes from the second quarter survey from the PBOC. Looking at this, and we can see investments from all of these companies, private and state-controlled, have fallen. Meanwhile, consumers don't want to spend money. Bank deposits are at a record high. And when asked in a survey what they would prefer to do with future money, 58% favored saving over consumption, over investment. And the gap actually seems to have increased in recent years, which is to say, nobody wants to be buying. Nobody wants to be investing. What that means is there is no demand. For 5 consecutive quarters now, China's economy has seen real GDP outpace nominal. Nominal GDP is nominal minus inflation equals real. Well, if real is bigger than nominal after that calculus, that means inflation is negative, which is to say the entire economy is on discount and prices are being cut to clear inventory because there's no demand. All of which is to say you can make credit cheaper in China, you can even force stocks higher for a while. But a bulwark against global recession that is lasting in that it revives growth for the second largest economy, that probably is not this. And so the world still looks to the US as the key to where things go from here and hope that the Fed doesn't get it wrong. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things go from there. On with Victor Jones for the Price of Truth Wednesdays. On with Chris again for Futures Power Hour Fridays. On with Victor and Tom for First Call Sundays. Writing for the News and Insights portion of tastylive.com. And commenting on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow. Happy trading.